recording. Get this kicked off. Thank you to the attendees that are here, and certainly to you three gentlemen for helping guide us through what kind of the world of crypto in credit unions and banks as an ancillary, and how custodians affect that process. We will be recording. The recording will be available afterwards. And to all of you attending, please feel free to kick off the Q&A at the bottom throughout any point of the presentation. Toss some questions in there and we will get to them at the end of the process if we've got time, and try and go through as many as we can. Based upon what Kian, Kevin, and Josh, I think we have time to answer this. So I will kick this off to you, Kian. I will sit in the background, put myself on mute, and let you guys go at it.
Sounds good. Appreciate you teeing us up, Rob, and thank you for everyone that is joining today. We've done several of these over the last couple of years now that we've been at this of trying to deliver crypto to credit unions in a compliant way. And a lot has happened over the last couple of years. And I think we're excited today to sort of give everybody here who may have seen us discuss similar topics in the past, but give everyone here just a current state of the union to address some of the recent themes that we've seen in crypto specifically, some of the headlines that we've seen, and really the considerations that credit unions should be thinking about in terms of, how and why you can go about offering crypto in a compliant way. And so I'm Kian, co-founder CEO here of CryptoFi. I'm joined by Josh from SRM and Kevin from Etana. I wanted to give an initial position statement and then kick it over to Josh and Kevin before we open it up some Q&A. But for those of you that or those that are listening in that don't know who Josh and Kevin are, if you guys want to start by just giving intros on yourselves, and then we can sort of go around the horn here. So Josh, go ahead and give your intro, and then Kevin, if you'd be so kind to follow up.
Fantastic.
Yeah, good morning, everybody. My name is Josh Herman. I'm a director of the Digital Assets Advisory Services team at SRM, which is Strategic Resource Management. Prior to that, I was at Frankenmuth Credit Union out of Frankenmuth, Michigan, about $1.2 billion in assets over there. And then prior to that, I was with NCOA for about 5 or 7 years, and decided to switch sides and come over and help the credit union space. So really excited to be on this webinar and participate in this conversation. Thank you.
Okay, I guess I'm up. Good morning, everyone. Kian and Rob, thank you for setting up this webinar today, and I appreciate the opportunity to be involved in it. My name is Kevin Hall. I am the Chief Operating Officer of a trust company in Denver, Colorado named Etana Custody. We are a chartered trust company and a regulated custodian. For those who are relatively new to the space, that when you are regulated, you're regulated by 2 different bodies. One, you're regulated by the banking division in the state of Colorado, and then separately, you are registered with FinCEN, which is a division of the U.S. Treasury Department. So we're a fully regulated and compliant trust company. My background, I've been in financial services for about 40 years, and I've worn different hats, then from trading government bonds to brokering raw materials and commodities to dealing in derivatives to allocating money. So I'm a relatively good generalist in the financial services arena, and that sort of helps support the operations here at Etana.
Awesome. Appreciate you both being on with me here. So for those of you that don't know me, like I said, I'm Kian, co-founder CEO here at CryptoFi, and really it's been our mission at CryptoFi to deliver compliant crypto solutions to credit unions now for the last couple of years. This industry has moved a bit slower to get to a point where crypto becomes table stakes for credit unions, but it seems as though we're absolutely heading down that path to make that happen. And I wanted to just really start by give my take on the current market conditions today, and really give more of the why credit unions should be thinking about offering crypto in this day and age, before the end of the year, I think is our recommendation. I'll talk about why, and then kick it over to Kevin and Josh to talk about some of the how credit unions can do that in a safe way. And that's one of the first things that we always like to communicate to credit unions is that, right now your credit union members are or a lot of them at least, are transacting and holding crypto on a lot of these unregulated exchanges, which has been the root cause for a lot of the headlines that we've seen with a lot of people, Americans, losing a lot of money on these unregulated exchanges. And so, with our solution, we sort of pull together all the necessary pieces at CryptoFi to make sure that we can deliver a very similar experience to what your members would otherwise be getting on, let's say, Coinbase or Robinhood today, but natively through your digital banking environment. And so at CryptoFi, that's what we do. We integrate with all of the major digital banking platforms that are out there, and then we connect to best-in-class qualified, meaning regulated digital asset custodians like Etana to make sure that your members' crypto is being held in a regulated way. And had that been in place for your members a year ago, your members may not have lost money with FTX. And so those are some important themes I think that are important to address in terms of the macro perspective as to why it makes sense for a credit union. In addition to the obvious points of if crypto is part of your credit union, it's going to be a powerful reason for your credit union to be able to attract new members, retain your current members, and also curb a lot of the capital outflow. One of the things that I would encourage anyone to do on this call that hasn't done it yet, if you're part of a credit union, is to study the amount of capital that is being transferred out to third-party exchanges. Rob Robinson, who teed this up on our end, has actually curated a list of line items to look for on the statements of your members. A lot of the exchanges out there will disguise their names, so forget all of them off the top of my head, but I think Binance, one of the line items for Binance, if your members are transferring money over to Binance, is like BAMF trading or something like that. That doesn't look like a crypto exchange. It doesn't say Binance on there, but they actually are transferring over to Binance. And when we provided this data to a lot of credit unions, it can be eye-opening in terms of how much capital and deposits you're losing, right? And once those deposits leave, they usually don't come back, because on these third-party neobanks and fintech platforms today, where you can buy crypto on, you can also take advantage of banking services on those platforms as well, right? We saw Robinhood launch a checking account and a debit card. We see SoFi now, where you can get a loan. You can also buy crypto on. And so if you want to be top of wallet, front of mind for your credit union members, from a holistic standpoint, offering crypto as part of the holistic service offering is something that's going to be important for you to consider, and why we've taken the approach that we've had to integrate this alongside the rest of your banking services that are available through the digital bank environment. So I think from a broad standpoint, those are some of the key considerations to think about. And then, more specifically, why now? Why should you consider rolling this out, this year or very early next year? And one of the big things that comes to mind is the Bitcoin halving event. So for those of you that are unfamiliar with what the Bitcoin halving event is, it only happens once every 4 years, and it essentially, not to get overly technical right now, I would encourage anyone to Google it if they're more curious about the specifics of how all this works. But to keep it overly simplified, it essentially reduces the amount of Bitcoin that's going to be circulating, which in turn will drive up the price of Bitcoin. And like I mentioned, this happens once every 4 years. The next time that this is happening is actually this coming April. And the last time it happened was May of 2020. And if you look back at the trading volume that took place for the 4 months leading up to May of 2020, it was multiplied by a factor of about 2 to 3x month by month, all the way leading up to that May Bitcoin halving event, and then for the month after as well. And so it's going to be a situation where your members are likely going to want to take advantage of the opportunity to invest in Bitcoin ahead of that event. And if you can get a crypto solution launched by the end of this year, you're going to be very well positioned to capture a lot of that demand from your members. And if you're one of the only credit unions in town that are offering Bitcoin, it's a great way for you to be able to market this, to attract new members. And then obviously any member that's going to be buying Bitcoin would be more likely to engage with the other banking products as well. So I think those are some of that in itself, from just a pure opportunity standpoint, is one of the most important things to be considering. And then secondarily, right now, just back to the point around safety for your members, we've seen quite a few exchanges go under over the last year, and that trend is likely going to continue. And these sorts of events do give a bad rep to the industry, but it's because of the poor risk management processes that these exchanges have internally, right? And so if you can offer your members a safer way to be able to buy, sell, and hold digital assets or cryptocurrency through the existing digital banking environments, you're going to be protecting your members from having those adverse events happen to them in the future. But with that, I digress and would like to kick it over to Kevin, actually, if you could just sort of expand on those topics.
Ken, those are many topics you introduced there, so I'll see if I can unpack that a little bit. First, I'd like to speak about just engagement in the industry and the growth of the industry. Many people think of blockchain, their eyes sort of glaze over, and they think that digital assets equals Bitcoin. And I do agree that the level of engagement, whether they're individuals investing or investment advisors investing on behalf of clients, we are seeing that there is this demonstrable and ever increasing interest in digital assets overall. So we feel that this is a secular change, and in fact, it's a migration from the traditional form of investing into a superior delivery mechanism, and also more assets selection to choose from. So when we look at digital assets, we think about Bitcoin, the different utility tokens, but also over time, that's going to expand to include things like tokenization of real estate, or tokenization of precious metals or energy and other types of assets which you can own in a digital form. So I think setting up the landscape now to be able to provide market access into cryptocurrencies, I think over time is a launch pad to provide a more comprehensive suite of things that you can trade on. So we as a custodian, we focus our attention principally on representing investors' interest in digital assets. So we don't extend credit. We don't have a trading desk. We only represent unilaterally the client's safeguarding of their assets and how they access and interact with the marketplace. And we're seeing currently there's huge demand in Bitcoin and Ethereum and other products like that, but there's also a growing interest in this expansion of what defines a digital asset and how they can actually participate. So I think credit unions looking at it in terms of the long game, in terms of what is the strategic road and how do I sort of manage my path down the road. I think the opportunity will be ever increasing, not narrowly defined by Bitcoin or another utility token. I think we have to make a distinction between what some of the bad press we've seen in the industry relative to the growth of the industry. Whether it's an exchange, the FTXs of the world, or the problems that the banking industry had, Silvergate, Signature, or some of the lending platforms, Celsius, for example. This is all, those problems were really either bad actors or incompetent risk management. And it had nothing to do with financial services, generally speaking, or digital specifically. So it had to do with the management teams and how they manage the business practices of those organizations. So I think if one were to really focus on what constitutes best practices, what is in the best interest of my membership, and how can we actually provide a reliable, repeatable, scalable business that's in the investor's best interest, I think it's a way to really embrace providing these services. So that relates to compliance, operational integrity, transparency, conflict of interest. And I think if that due diligence includes those different buckets, I think the result of that would be a service offering to your members that, in fact, I think really is in the members' best interest and ultimately strategically in the credit union's best interest.
That's great context, Kevin. Josh, if you wouldn't mind putting your consulting hat on for us and give us your just general take, I think, on the state of the industry right now. And I think one thing that we haven't touched on specifically that'd be good to hear from you on would be the SEC case that we saw play out with Ripple last week, and how that might be impacting the industry moving forward. But if you want to start with your general thesis on the industry today, we'd love to hear that. And floor is yours, Josh.
Yeah, so I'm going to take a big breath here to get through all of this. But on the advisor side, I really think that discussing custodial relationships and custodians is an extremely timely and relevant and important topic, especially as it relates to due diligence. We'll talk about this throughout the webinar, especially FTX and those things. As more and more credit unions look to adopt these cryptocurrency solutions, which, by the way, more and more credit unions are looking to onboard cryptocurrency solutions. Finding the right partners is really going to be important. And it's important to understand the custodian's role and assess what those risks are. I think a lot of times credit unions, CryptoFi, Kian, your company, and custodians all get lumped into one bucket, and they're not. They're all separate entities and they're all separate firms. They all have their different operating structures, different parties involved, different risks associated with them. I think it's important to understand that, and we all know this in the credit union space, and the FI space, but you can't outsource responsibility to a third party. You can have somebody else doing the tasks, but ultimately the responsibility lies with you as a credit union. So you have to know how Kevin's company operates. You have to know how Kian's company operates. You have to know how your credit union operates. You have to understand the flow. You have to be able to explain it internally, both to your staff, to your board, and to your management teams. But you also have to be able to explain it to examiners and auditors and actually your members as well, because they're going to be having questions. But primarily, you have to be able to understand it to identify and mitigate risks. I think, and this is something, if I can park on this for a second, there's a pseudo complexity that exists with this space. And by pseudo complexity, I mean it's a false complexity. And obviously there is some differences between this and normal traditional finance, but there's a lot of terms and a lot of uniqueness to digital assets that makes it seem really, really complex. It actually keeps people away from getting involved because it seems so closed door and it seems so complex. But I have found personally that the more educated people get, the more educated that I get on the topic, the less complex it actually seems. So all of us on this call obviously highly encourage education, and I know CryptoFi has a really good and excellent educational resource library, but you really need to know your partners and vendors in this space. So whether it's CryptoFi or another solution, or whether it's Etana or another custodian, you have to have those conversations and you have to understand it. I know the teams at both of these firms are happy to educate and have those conversations. And obviously at SRM, that's what we're in the business of doing. So we're happy to have those conversations as well. Now, when it comes to Ripple, I think you're seeing a couple different sides coming out where it's a victory for Ripple, and then you're seeing a tapping of the brakes saying, well, hold on a second, this was a partial decision, or however you want to split the legalese. But I think it takes some of the headwinds and gives a little bit of momentum behind the crypto movement, at least from my perspective. It's been such a knockdown that whenever Bitcoin or whatever measurement you're using to measure the crypto space, whenever there's a little bit of influx or positivity, here comes 25 news stories knocking it back down about fraud or whatever. And it's like, I've never even heard of some of these places, and it's kind of tainting the entire industry and the entire space. And so I don't think that's really fair. So when you get a win like a Ripple, even if it is, in the grand scheme of things, a small win, I think it is a crack on the shell of negativity. And I think it's momentum that needs to move the positive needle a little bit. And Kian, you talked about the Bitcoin halving event. And I think it's really important for credit unions to understand not just that event, but events that take place in the space. And a lot of times we'll see investors and traders trying to time the market, right? Even on the equity side, you'll be trying to buy and sell. And if you do it the wrong way, you're going to be selling high and buying low. That's the way a lot of people participate in the space. But credit unions are trying to time the product launch as well. And so they're trying to catch the momentum. And if you're waiting for the actual event to happen, you're going to be behind. We know it takes credit unions a year plus, 2 years plus to actually go through a proper due diligence stage, onboard the system, go through testing, go through beta, and actually launch it properly. So if you're looking forward to some of those events, now is actually the time to be having those conversations and implementing into your strategic plans. So like I said, I took a deep breath there and got through it. But happy to be on this call. And this is a really timely conversation.
No, that's great. Great feedback there, Josh. And I mean, Kevin, would love to hear from you too, your take on the SEC versus Ripple case and how that might impact credit unions and what coins they might think about offering in the future. If you could bless us with some of your wisdom.
Sure. First, I'd like to just sort of compliment Josh on his observations there. I do think that it is a strategic process to be able to provide these services in an institutional, predictable way. I mean, it does have implications for compliance department, documentation, operations, marketing, client communications, and client education. And people want to do it right the first time. So it takes time to go through that process. There's a self-education, and then there's a socialization internally, and then a way to actually provide that in a reliable way to the membership of a credit union. And I think taking a slow, deliberate, thoughtful approach to migrating in that direction, I think is actually probably the best way to expedite the process, because it is deliberate, it's intentional, and it's not a rush to the finish line. Because I believe that the digital asset opportunity is strategic, and I think it's permanent. And it could take months or quarters for our credit union to actually ramp up. And but by starting now and sort of setting up a team and going through that process, I think that it only leads to a constructive outcome. That's my opinion there. With respect to suitability in the XRP Ripple, at Etana, positives and negatives. I think anything which promotes regulatory clarity is a great thing. And I think to date, we've had a murky understanding as to what is or is not regulated, who regulates it, and what are the implications of dealing in a non-reg, or how do I report, what to report to. And I think one of the biggest elements of the inertia of the industry is this lack of clarity as to what this thing is and what am I supposed to do with it. So I think as these legal cases come to fruition, and I think it leads to a conclusion, but also a discussion. And I think all of these things help people better understand the landscape, the asset they're dealing in, how they want to position themselves relative to that asset. So I look at this as a very big positive. I think at Ripple specifically, I'm not an attorney, and I don't represent the compliance department of Etana, but we do have a very regimented approach here to determining what should or should not be supported as a custodian. We are very respectful for the SEC and what constitutes a security, and what's not a security, and what is in the best interest of the investor who works with Etana. So I think that as it relates to market access, we are very, very thoughtful with respect to our own internal due diligence, and we're more than happy to communicate our logic and our findings to the credit unions, explaining our rationale for what to support and not to support. And because we want everybody to be on the right side of the trade, so to speak, in terms of best practices and suitability. I think XRP itself, I think the jury's out a little bit. I think the conclusion was made a separate view as to institutional and private investors, and I would suspect that the SEC may try to appeal that conclusion. So, though I think it's great strategically for the industry, I think tactically, as it relates to Ripple specifically, I don't know if the book's been completely written yet.
Yep, that's great feedback. So, starting to get some questions in here. So, going to tee these up to both Josh and Kevin. Josh, if you want to maybe take the first one here. I think this is a really important consideration. I think we see a lot of headlines around self-custody and the whole not your keys, not your crypto aspect of it, which is stark comparison to a qualified custodial approach, where the custodian's actually custodying the crypto on behalf of the members. So Josh, you want to give us your perspective on maybe the differences and some of the pros and cons to self-custody versus leveraging a regulated custodian like Etana?
Yeah, and like you said, I think there's pros and cons to both. So there's the saying out there on social media, not your keys, not your crypto, and I think that's a very valid statement to say in some cases, but I don't think that's the case all the time. One of the things, and I'm gonna be short on this and toss it over to Kevin because this is his space. But I think one of the things to be cautious of is that credit unions and the financial industry as a whole is typically known for being a safe place to hold your funds and hold your money. And there are always going to be fraudulent or poorly run institutions. I think SVB was a good example of just a poorly run institution. And some of these other banks as well. But that should not deter people from keeping their funds in a regulated financial institution. And I think that's one of the things that Etana is a fully regulated financial institution. Some of the downsides with self-custody is if you lose your keys, you're kind of out, right? And I think, Kian, you have a good stat that maybe 20% of Bitcoin or 20% of cryptocurrency is actually lost because people just flat out forgot their keys. Whereas, self-custody, and obviously there's going to be failures at custodians. There's going to be missteps and things like that. So we don't want to, again, characterize the whole industry by what's going on at one place. But overall, custodians are going to be a great place to keep your cryptocurrency, as long as you're doing your proper due diligence, as long as you're checking on what's going on. We talked about this earlier. You can't just hand off responsibility to somebody and kind of wipe your hands and say, well, it's all safe because they said it was going to be safe. That's not, their responsibility is to be regulated and to keep your funds safe. Your responsibility is to, again, make sure your members' funds are safe and be running checks on them as well. So from a traditional financial institution guy, someone who's been in the credit union space for over a decade now, I can't think of a better place to keep my funds than a credit union sourced vendor type situation. But again, Kevin is the expert in the space. I'll hand it off to him on that.
Thanks, Josh. I'd like to make just one sort of an overall observation, then we can speak about wallets specifically. I would say that it's my understanding that really it's the exception to the rule that people would self-custody a portfolio asset. Like if you buy stocks, you keep them at a brokerage company. If you have a CD or a cash, you keep it at a bank or a credit union. It is, you don't keep the money under your mattress type thing. So, and there's a reason for that, because you're leaving your asset with a trusted third party who can actually provide, secure custody, reporting, asset verification, all those things associated with responsible investing. And I think that digital assets should be held to that same standard. And if one wants to consider a different approach, there has to be a compelling reason not to conform to what has been battle tested by every other investment class globally, historically. I just want to throw that out there. So I think really it's an interesting argument. I would say that self-custody, there's always a use case for it. There's always unique situations that lend itself to self-custody. So I'm not going to say that categorically it's a bad idea, but I would say that the general observations would argue against that. I mean, first, as you said, if you lose your wallet, you lost it. And if you lose it, it's gone. The next, if you actually lose your password or the key, because for those in the audience who are not sure, a key is sort of synonymous with a password. How do you get into the wallet? If you lose that, your wallet becomes a paperweight, because even though there might be value in it, you can't access it. And that's basically what happened at Prime Trust. They had these wallets, but they couldn't get in the wallets. So really it was tantamount to asset destruction, because you could not access that asset. So you might feel comfortable holding it yourself, but I think the ramifications of managing that incorrectly or making a mistake could be devastating. When you are looking at to a third party, these people actually can recover that. It's their responsibility regulatorily and commercially to make sure that wallet is safeguarded, available, and usable all the time. They have operational procedures in place. There's insurance in place. There's many, many different ways to ensure that asset that is being held correctly, reliably, and you have access to it. Another negative for a self wallet is just the range of assets. Each week, each month, there's a new digital asset out there. And as you want to expand your investment options and opportunities, you want to make sure that the wallet that you're using can actually accommodate different investments from time to time. It's the job of the custodian to ensure that the widest array of assets can be maintained, reliably, responsibly, and predictably. That's our job to do that. And the last thing, which I think is equally as important, is the whole concept of transaction monitoring. When you buy an asset, you want to make sure that asset is clean, pure, and defendable. You don't want to be involved either inadvertently with someone who's a bad actor, someone involved in money laundering, or some other nefarious activity. And it's the job of the regulated custodian to actually do the AML, KYC, transaction monitoring, to make sure that the Bitcoin that you purchased or the digital asset you purchased came from a credible counterparty. And so the combination of just, ensuring that you have access to your assets, there's asset verification, there's insurance, there's management, there's the ability to expand your ability to hold different assets, and to ensure that there is a level of compliance associated with the transaction behavior. I think all these things lend themselves to working with a third party capable custodian.
That's a great input. So gotten several questions in. I'm going to mold a couple of these together here, just related to topics around certain benefits that a credit union and a credit union member may enjoy from an integrated solution like the ones that we offer. And specific, Josh, so I'll direct this question to you. So how does using a qualified custodian with a credit union help to eliminate asset liability? Is there any benefits around reducing the concentration of risk for digital assets? Any benefits around eliminating fraud by doing it this way? Identity theft, account takeovers, synthetic fraud. Those are all different topics I think we got questions about. So feel free to pick whichever ones that you feel comfortable speaking to and give us your take.
I'll choose all of them. I will answer all of those. So from a ALM and asset liability management standpoint, I think that's a very interesting question, and it's kind of a backdoor type question, because on the surface, credit unions aren't holding cryptocurrency, right? And so that's what Etana's doing. That's what all these custodians are doing. And so when you're using a licensed and regulated custodian, a credit union is not actually holding that crypto. And so on the surface, there's no ALM concerns. Now, the backdoor to that is a member's flow of funds. And so when a member's transferring funds from their checking account or from their savings account, purchasing crypto on the credit union platform, and those funds are leaving, you do have to take that into account. I don't think it'll be anything, and this is my opinion, anything super material from an ALM standpoint. You need to do anything with that, but you can obviously watch what's happening and adjust your ALM modeling based on those activities over a period of time. But no, if on the surface, credit unions aren't holding crypto, but on the back door, it is something to watch from a share leaving the door perspective. And I think the other alternatives, and something that I think Kian has talked about before, is would you rather those funds stay within your credit union ecosystem, so it's all taking place through your app, and all of those things, even though it's leaving your credit union books, it's staying within your app, and so funds can be transferred back and forth very flawlessly in the terms of CryptoFi solution, as opposed to if you're going with the Robinhood or one of those other type solutions, the funds are actually ACH or however leave your institution. So it's a lot more lift from the member side, and a lot more time from the credit union side to actually transfer those funds back and forth. But no, that's a very good question on the ALM side of things. Probably something to consider once you see a pattern at your own credit union, and you can budget that into your ALM practices. Let me see some of the other questions. Your concentration risk would be the same type of thing. From a fraud perspective, I think you're going to have fraud and identity theft and account takeovers kind of anywhere that you go. I mean, it's just always going to be a thing. I think the question specifically says eliminate fraud risk. I'm from the regulatory side, I'm very careful to not use absolute words like eliminate and guarantee and things like that. I mean, obviously there's ways to mitigate and reduce that down, but you're always going to have fraud and different things like that. I think one of the advantages, and Kian, maybe you can talk to this, or Kevin, you can talk to this, is Etana's system, at least in the credit ecosystem, from my understanding, is closed loop. And so if there is an account takeover and someone gets into your credit union account, they buy Bitcoin, from my understanding, they're not going to be able to actually transfer those funds out to an external wallet. And so it's all going to be maintained in there. Now, could they get into your account and transfer funds out via your normal credit account? And that's going to be up to your credit union how that's handled, but that's how a normal account takeover would take place. But it's not going to be, from a crypto standpoint, it's not going to be an exit out into some anonymous wallet somewhere where fraud's going to take place. Kevin, Kian, feel free to correct me.
No, that's good. Just to layer on that, Josh, I mean, you're absolutely right. With the solution that we have, CryptoFi has with this partnership with Etana, it's a closed loop system where members can only buy, sell, and hold cryptocurrency. They cannot actually send cryptocurrency to a third-party wallet outside of the credit union ecosystem. And because of that, if there ever was any account takeover or somebody hacked into a member's account, they could not send crypto outside of the credit union walls, which would be custodied by Etana. And because of that, it's going to reduce any risk that would be associated with crypto specifically being held within the credit union walls like I'm referencing. Whereas if someone hacked into your Coinbase account, for example, they could transfer themselves crypto to a third-party wallet, which opens up members to additional risk, and another reason why it's safer for credit unions to offer their members crypto natively through their existing banking apps. So, I mean, these are very credit union specific topics, Kevin. And while I respect your knowledge on the breadth of financial services, I wanted to direct a different question that we got your way, more specific to Etana and custody. I think just addressing some of the headlines that we've already touched on. Would love to hear your take, Kevin, as to you referenced Prime Trust, but other names we've seen, like I think you referenced like Signature, Silvergate, SVB, FTX. Why did these things happen, and why do you feel Etana is likely not going to have a similar course of events play out where credit union members would be putting their assets at risk if they were to park them with Etana?
Well, let's address the banking issue. Very different than the exchange issue. These are two different industries, and there were two different dynamics which led to the negative events there. So I would ask us not to bunch those together because they're very, very different concepts, actually. The way that it's Etana's job basically to protect the client's assets. We have to hold these assets in a secure, compliant way for the benefit of the investors. So there is asset protection, there's asset verification, and there's a protection against the trading venue. All right. So it's our job to ensure market access, but in a controlled, predictable way to allow investors to have access to a price to buy, a price to sell. But we settle those transactions so the asset doesn't really leave our premises. We just sort of transact. So there's always this protection of the client asset. Markets separate the custody of an asset from the trading venue. And so it's one thing to deal. If you trade on the New York Stock Exchange, you don't have an account with the New York Stock Exchange. You have an account with a broker, and you happen to transact in that liquidity venue, let's say the New York Stock Exchange. In the case of FTX, you were working for the company store, effectively. They were the custody of the asset, they were the trading environment of the asset, and there was no transparency as to what's going on behind the scenes. So you didn't know whether they were acting as an agent, matching orders as an exchange should, or they were trading against that price. And you actually didn't know whether they were taking those assets and using them for their own purposes or not, because there was no transparency, there was no reporting, which leads itself to these nefarious type activities. So if you look at FTX, that lack of separation of powers, that lack of oversight, that lack of reporting, that lack of transparency had lent itself to this rather devastating consequence of FTX. The business model within the CryptoFi Etana support service, there's an intentional and a deliberate separation of the custody of the asset from the client's ability or the member's ability to transact and to buy and sell digital assets. So the construct, the intent, the motivation, the regulation, all these things are designed to protect against what happened at FTX. The situation in the banking industry is a very different one in that these banks, whether it be Silvergate, Signature, really the core function that they were providing to the industry was a cash management service. Basically a big checking account to allow people which are transaction oriented in the industry to manage their daily cash balances. And these banks got very, very large in terms of accommodating huge cash balances. And a way to create profits, they took these cash balances and they invested them in long-term treasury securities. And so they would earn the interest rate differential between the zero interest they're paying to their depositors and these very, on a relative basis, high interest rates in the bond market. But understanding that mismatch, the clients want their money back tomorrow. It's like a checking account. And so when interest rates went up, these bonds that they bought had significant unrealized losses associated with those things. So when the clients wanted the money back, they had to liquidate these bonds at a huge loss, and that created the liquidation debit, or that financial crisis that took place in those banks. So it's not as though it was nefarious, like was in the case of FTX, but it was irresponsible in terms of portfolio management, risk management, portfolio construction, and it's tragic and it's horrible. And I think it's a lesson learned situation. As it relates to our operation, these are fully funded activities. The investors and members are buying a Bitcoin, they're paying for that Bitcoin, there's no leverage, and these are their assets. So I think that the problems that we saw in the banking industry, the problems that we saw in FTX are tragic, they're unfortunate, they're due to really, I would say, incompetent or irresponsible management. In some cases nefarious, in some cases just inappropriate. But I would say that this is very, very different than the business model and the way we execute here at Etana.
That's great. And we've got a number of questions here, so I'm just going to go sort of in order, and we'll do our best to get to all of these. But whatever questions we can't get to, anyone on this call can follow up with Rob Robinson here, and you can direct those questions to Josh, Kevin, or I accordingly. But we had a question around stablecoins, and stablecoins aren't something that CryptoFi is currently offering to credit unions. We think that stablecoins do play a crucial role in the payments ecosystem for digital assets, which is something that is on our roadmap. But I'd be very curious, Josh, if we could hear from you first on what role, and the specific question was, how do stablecoins play a role in limiting risk for credit unions? So Josh, would love to get your role on that specific question and just how you think about stablecoins and what role they play in this whole ecosystem for credit unions otherwise.
Yeah, that's a very interesting question about how it limits risk for a credit union, and honestly not really something that I've spent a whole lot of time thinking about. From a stablecoin standpoint, it would depend what they're backed by. It would depend, I mean, are they algorithmically backed, or are they actually a one-to-one reserve type back? Where are they actually being held? It's going to be the same type of risk look that when we're talking about Etana or something like that you need to actually be doing these checks and things like that. To your point, Kian, stablecoins definitely, there's potential for them to be playing a role, and it depends on if you're looking at stablecoins or tokenized deposits and which side you're at on all of those things. I think there is definitely room for stablecoins to play a role from a risk standpoint. We'll have to see what the use cases for those actually are. I mean, in the current product offering, so for example, on a CryptoFi type situation, it's closed loop. You're going to go out and buy your Bitcoin, and you're going to sell it, and you're going to transfer funds back to your credit union checking account. So I'm not really seeing where a stablecoin would have a play. I mean, so if you're buying a USDC or something just to have a one-to-one ratio with a US dollar, why not just transfer it back to your checking account? Because it's not an open loop where you're going to go and use those anyway. So that's a very interesting question. I don't necessarily see a full use case for it right now, and maybe that'll develop. But yeah, definitely an interesting topic.
Yeah, Kevin, what's your take on this too? The one thing I'll say on it, I think stable coins are a very valuable use case when it comes to payments. I think the challenge that we see today, at least in the US, is there's just not many retailers or even e-commerce platforms that are accepting stable coins as payments today. Now paying, your friends or peer-to-peer payments, stable coins could make sense. And there's definitely use cases for it. But I think there's some work to be done in terms of the infrastructure that needs to be rolled out from a payments perspective for merchants and other venues to be able to accept stable coins before it can play a more vital role in this whole ecosystem. But Kevin, curious to hear your take on the whole stablecoin topic.
I mean, from my perspective, a stable coin has value from a transactional perspective, but not necessarily, it's not better from a store of value perspective. So if you have a cash balance, you can earn interest on that cash balance. If you own a stable coin and you're not earning interest on it, it's effectively a zero interest rate environment. You're holding an asset, it doesn't depreciate because of the proven reserves against it, but you forfeit the opportunity to earn interest on these balances. So I would say as a store of value to hold, I don't really see the compelling argument for it. As it relates to transactions, whether it is a payment, remittance, where you're trying to move something and or you're trying to buy another digital asset with it, I think the strength of a stable coin is the immediacy of the settlement. So in the same way that you're not limited to the bank hours in terms of wires or ACHs and things like that, this does give you the ability to receive or to give that stable coin to a counterparty for whatever the use case is instantaneously. So I think transactionally it's probably, I won't say superior, but it's a compelling argument. I think as a store of value, it would be hard to defend that as a better option relative to keeping your cash at a credit union.
That's good input. All right, shifting gears here. So Josh, again, putting your SRM consulting hat on, when you're evaluating different custodial options or helping credit unions vet different custodial options, what are some of the key criteria that you look for whenever determining the right custodian to be working with in this case?
Yeah, I think the biggest thing is just going to be understanding the flow and actually understanding what's going on. I mean, because I can have conversations as a credit union, I can have conversations with you, Kian, all day and still not necessarily understand what's going on at the custodian. So it's really important for credit unions to actually dive in and understand the flow of funds from the credit union to Etana or to whoever they choose as their custodian. And how all of that's working. It's important to understand. I see questions in the chat about insurance and about who's regulating Etana and about licenses and all those different things and operating in different states. It's important. Those are actually perfect due diligence questions. It's important to understand all of that because Etana is licensed and regulated by the state of Colorado and different things like that. But it's important to break through and understand those. And it's a very, from a surface level, it's a very similar due diligence type process that you go through with analyzing any other critical type of vendor. Obviously, there's going to be nuances, again, with the flow of funds. I think a big question for Etana custodians is how are you verifying that the crypto that you're getting is going through your BSA type systems, and who are you using for that? Is it a chain analysis? Is it an elliptic? Kian, your firm, what are you doing to check to make sure funds are still there? Credit unions, what are you doing to make sure funds are still there? Because as much as Kian and CryptoFi can do to make sure funds are there, again, we can't outsource that responsibility. So you have to have a process in place to make sure that Kevin and his team are doing what they're saying they're going to do, and that CryptoFi is doing what they're saying they're going to do. But all of that comes back to understanding what you're actually getting involved in. Then you can identify all of those risks. And I can even give a credit union checklist and say, these are things you should be looking for. But as a credit union, it's more important for you to be educated on the topic and know what you're actually looking for as opposed to going through a simple checklist.
Yep.
Just as the other side of the due diligence review, I mean, being intellectually honest, I think there are 4 boxes that have to be checked. The first box is, are they regulated and by who? Okay, I mean, some people say I'm regulated, but are they? It's like a trust but verify type thing. We have to do that. The next is, how robust is their operations? I mean, are they SOC 2 from a technology point of view? Do they have a robust compliance, AML, KYC, BSA? Do they have the tools to actually do their job correctly? And the last is, are there conflicts of interest? How do they make money? And I think where the rubber meets the road many times is the commercial model. Because you might find someone who's very regulated, has very, very strong infrastructure, but in fact, their business model is conflicted with the credit union and its membership. So I think if you're comfortable regulatorily, operationally, and you understand how they pay the light bill, I think these things collectively should give comfort or a lack thereof relative to doing business with them.
That's great, Kevin. I want to ask you just to expand on that maybe a little bit. I think one of the common questions that we get, and I see in the chat as well, is around insurance. And obviously, cryptocurrency is not FDIC insured; it's not NCUA insured. But what level of insurance can credit unions and their members expect? And then, how does that play out in the event of a bankruptcy? And I sort of know your take on this. It's not an easy question to answer, Kevin. So if you could just do your best and help people understand the considerations here.
I will answer them as the best I can. All right. And so as it relates to the treatment of a bankruptcy, I will give you my, these are not the words of management. These are the words of Kevin Hall on this particular topic. The insurance. Regulated custodian, any custodian you're working with should be able to provide protections for your assets. And those protections are a function of regulation. They're a function of key management and other internal control policies and things like that. I mean, I'm not trying to dodge, I'm not trying to give a very comprehensive answer to that. So in doing due diligence, to say that because you can't just rely on insurance. You have to rely on business integrity. So like, how does the company operate? What protections do they have in their policies and practices, which would create an environment where you don't need the insurance? If you just rely on, life insurance, you have to be dead to get it type thing. And then ultimately there have to be insurance that is actually usable. So I think any custodian must be able to respond to that question directly and not dodge it. And if they dodge it, they fail due diligence. So I just want to throw it out there. And I think the insurance question includes policies, practices, change of control, all the key management, all these things, because that is the preventive medicine of having to use insurance, in the first place. What is the treatment of a digital asset in bankruptcy? That is a very relevant question, a complicated question, and one where there's not a concise answer yet, honestly. If you were to look at stocks and bonds, there's a lot of case law and regulations which sort of define the treatment of these different financial assets in the case of bankruptcy. We never commingle corporate capital with client capital. I mean, so in terms of structure, all of our client assets are segregated from ours. Kian, to your question about asset verification, in the case of these credit unions, each one gets its own unique cold wallet, so they can go on chain and look at their assets themselves. So they can trust that we're a good regulated custodian, but we'll also give them the wallet address and they can go check themselves for the asset type thing. So I feel very confident that we can show a business structure that's very protection. Right now, there's case law. If you look at BlockFi, Celsius, these other organizations where in the bankruptcy, they were holding third-party client assets. And what the treatment of that asset is in bankruptcy is currently being proven out in the courts. And I think that literally in months, not years, there's going to be a crisp understanding as to what the management would be, in the outside chance that a custodian goes bankrupt.
Yep. And will be very interesting to see how that plays out over the next couple of months, like you said, Kevin, and I'm sure we'll do our best to keep the credit union industry updated on that. So shifting gears a bit, we only got a few more minutes. Josh, last question, and then we can have some closing statements here. But being that you're coming from SRM, Josh, and that you're more unbiased than I think Kevin and I both are, what advantages can you summarize for a credit union and their members as to why it makes sense? Why would it make sense for them to, buy, sell, and hold crypto through their credit union versus doing it so on an exchange like a Coinbase today?
Yeah, I think I mean there's a lengthy answer, but I'll start by answering why is it better for them to bank with your credit union as opposed to going to Chase, right? I mean you're always going to have your differentiating reasons as to why you're better than your members taking their funds and going somewhere else. That's what you exist for, is to serve your membership. Now, if we look at someone like, and I don't want to go after a Coinbase, but if you look at someone like an FTX or someone like that, there's a very different way in the way that things are handled. FTX, I mean, essentially, Kevin, what you said, it essentially was fraud, smoke and mirrors, right? Whereas a credit union, number one, is regulated. Etana is regulated. And these are not easy regulations to comply with. There's a lot of licensing that needs to take place. There's a lot of due diligence requirements that take place. There's a lot of membership funds at risk. And so when your credit union gets involved in something like this, they're not taking it lightly. It's not a matter of just going out there, signing somebody up, and they're hands off and it's done. Their examiner is going to be asking constant questions. Their auditors, their board, all of these people are going to be asking, their membership is going to be asking constant questions that they're going to have to constantly be asking, having to give good answers for. Otherwise, people are going to leave the institution. So it's very much similar to other products where you want to be the trusted financial institution for these transactions, whether it's an auto loan, whether it's a certificate of deposit, whether it's purchasing a stock, or whether it's going out and buying Bitcoin. You are your members' trusted financial institution, and you need to continue to be that. If you're wondering why they won't go somewhere else, you need to really focus on your differentiation of what makes you different from other institutions to begin with, because you don't want them going to the Chase or those other platforms, because it's going to be a pain trying to bring them back, and it's going to be really expensive as well.
Yep. Great answer, Josh. All right, only got a few minutes left here. Kevin, final thoughts on any other topics that we haven't addressed, or summarizing what you've already discussed?
I think today's conversation has been rather comprehensive, and I've really enjoyed these challenging questions and this rather insightful conversation we've had. I mean, for me, I think the digital asset, I might be speaking my book here a little bit as a custodian of digital assets, but I'm very, very bullish the space. I think that there's a lot of attributes of blockchain and digital assets that reside on that blockchain, which I think are compelling. And I think that the industry, the financial service industry, is going to go in that way. And I would recommend that everyone, seriously investigate how best to expand their service suite to do that. So I think that, trading Bitcoin and other utility tokens, I think that I'm not giving trading advice or investment recommendations, but I do think that, it fits into the portfolio process and wealth creation. And I think people should take a look at that. To Josh's point about, credit unions and Etana, each of our organizations are regulated, and our mission is pure. We represent the investor interest of the membership. So that is the mission statement and the mandate of a credit union. And we do not extend credit. We do not trade against the clients, and it's our job to facilitate responsible custody and market access. So I think we are aligned philosophically on how to do that. And I think working together as the industry grows, we can provide a growing comprehensive support for that market access, which would be consistent with industry growth. So I think it makes sense tactically in terms of driving revenue. It makes sense tactically in terms of maintaining membership interest in the firm. But I also think it makes strategic interest in embracing this, ever expanding market sector.
Love it. Josh, final thoughts.
Yeah, I would just say, if you're a credit union out there wondering if you should get involved or not, or if you're starkly against it, I would say listen to your members. And it's not even a direct conversation that you need to have with them. You can go and actually pull your transactions and see where funds are flowing. And more times than not, what we're seeing at SRM is that there is a shocking amount of funds leaving an institution. And by shocking, I mean far more than expected, leaving an institution and going to other platforms and third parties. And so your membership might not raise their hand or send an email and say, hey, when you're getting a crypto solution, they're just going to set up an ACH and ACH it out to another platform. And more than likely, you're not going to see those funds again. So listen to what your membership is saying. There's the impression out there that this is all kind of thrown together, that it's messy, that's super complex. I think Kevin and Kian really laid out today that it's not messy. There's a lot of really big and complex firms involved in this space. So it's not just thrown together. And if you start waiting until the next boom to start implementing, you're going to be behind. Members will already have their preferred platform. You'll be running 1,000 miles an hour trying to catch up, if you even can, and just watching those deposits leave your institution. So some people, like we talked about, some people try to time the market from a buy-sell perspective, and some credit unions might be looking to time the market on implementing a solution. My overall advice and the drum that I'm kind of beating is listen to your members. Your membership might be saying not to get a solution. If that's the case, listen to your members. If your members are saying to go look at a solution through their spending patterns, then go look at a solution. And obviously from SRM's perspective, this is a good place to start.
Yep, I love it. And speaking of that list, if you are interested in that ACH line item list where you can actually get all the exchange descriptions for those line items, you can do that study more accurately. Please follow up with Rob Robinson here. I know we only got about 30 seconds or about maybe 90 seconds left. So appreciate everyone's time today. If your question did not get answered, also please follow up, and we're happy to triage that to make sure that gets answered effectively. But Rob, I'll turn it back over to you if there's anything else you'd like to address before we all log off here.
No, I think we are good. I will have recordings available for this. We will post it on our website. I will send an email to the attendees and everybody who's here with a link to that. We'll also have a couple of transcripts for those of you who prefer to read the chit chat version of this, just in case. We appreciate everybody showing up. Thank you very much. We will see you on the next webinar sometime in the next month. Thank you.
Thank you.